Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. Today we're going to be covering the decision as to whether to make pre-tax or Roth contributions to your 401k account. This also applies to 403bs, 457s, but in general there are a number of factors that come into play in making this decision, including your age, your time horizon to retirement, your income level, what's your marital status, what do you anticipate your income level is going to need to be in retirement, and then there's also some anomaly situations that come up that could cause you to change the pre-tax to Roth in a given year. And on the back end of this video, I'm also going to cover a bunch of frequently asked questions we get from employees that aren't as familiar with the Roth contribution source. Let's start off by talking about the difference between pre-tax and Roth contribution. So a lot of people are familiar with pre-tax, which is don't tax me on it now, tax me on it later in retirement. And the way pre-tax contributions work is if you're making deductions out of your paycheck to your 401k plan, they take out the FICA tax, but they don't take out Fed and state income tax. You instead get to put that in your retirement account, invest it, it continues to accumulate, and then when you withdraw balances in retirement, that's when you pay tax on the full balance. Now, comparing that to Roth by comparison, so Roth is tax me on it now, don't tax me on it later. So if you're making Roth contributions to your 401k account, they take out the FICA, but they also take Fed and state income tax out of your contributions. But the benefit is all the accumulation that happens between now and you withdraw the account in retirement, you pay no tax on any of it, including the earnings. Your age and time horizon to retirement is probably one of the larger factors in this decision. The younger you are and the longer you have to retirement, you have longer time to accumulate. That can tend to favor Roth because, again, all that accumulation can be withdrawn tax-free in retirement versus someone who's within 5 to 10 years of retirement. That accumulation window is much shorter and you could be withdrawing much sooner. That could favor pre-tax. However, the next factor we're about to talk about can trump age and time horizon, which is your income level. So in general, the higher your level of income, the more it begins to favor pre-tax because they're taking out such a large piece in Fed and state income tax that you might benefit more by saying, I'll take the tax deduction now, and hopefully when I'm in retirement, I will be in a lower tax rate. Vice versa, if you have an employee who's, let's say 22, they have their first career, they might be at their lowest level of income of their working career, expecting that over time that their income is going to increase. So it might make sense for that individual to say, just tax me on it now, I'll do Roth, and then later on, as my income increases, then at some point in the future, I can switch over to pre-tax. To piggyback your income level, you also have to consider your marital status. If you're a single filer, it's pretty straightforward. You know your income, you know your tax bracket, but if you're a married filer and you file a joint tax return, it's not just your income you have to consider, it's your spouse's as well. Because if you make, let's say, $30,000 a year, that might lead you to say, well, little bit of income, I should probably go with the Roth side. But then if your spouse is making $200,000 a year, your combined income is really $230,000, which could lead you more towards saying, hey, we need the tax deduction, we need to reduce our income, let's go the pre-tax route. Your marital status changing during the year can also make you pivot and change the type of contributions that you're making. Again, if you were making $30,000 and then you get married mid-year to someone making $200,000, you might have been doing Roth for the first part of the year, but that entire year may be looked at as a joint income, so you might have to then pivot to a pre-tax, realizing your combined income is probably going to be higher that year. Same thing in cases with divorce. If all of a sudden, we were filing a joint tax return, but now it's just my income and I'm a single filer, that could also change, so you have to go revisit that decision. The next factor to consider is what your income picture is going to look like in retirement. Now, a lot of people are making estimates here, like a 25-year-old, they're probably saying, I have no idea what my retirement picture is going to look like. I just started my career. You usually rely more on your tax bracket in those cases. But as you progress along and you're in your late 30s, 40s, 50s, you start to get a glimpse as to if I'm making $150,000 now, and by the time I retire, I expect the mortgage to be paid off, kids are through college, all of those things, and maybe I only need $75,000 a year to live off in retirement. retirement, you start to get the feel that say, okay, I'm on this bracket now, but by the time I get to retirement, if I only need $75,000 per year to live off of, I'm going to be in a lower bracket, which that situation can obviously favor pre-tax contributions. But we also run into those cases where someone says, hey, I'm 5 years of retirement, I'm making about $150,000 now, I'm probably going to need $150,000 to do everything I want to do in retirement. So their tax bracket really isn't going to change. So if pre-tax benefit is take it off now and pay tax on all of it later, that might not make sense. Instead, we might say, well, since your tax bracket's not going to change, we might as well just have you make Roth contributions, pay tax on the contribution piece, and then when the earnings accumulate, you at least get the earnings piece tax-free when you withdraw it in retirement. A second type of withdrawal plan consideration is whether or not you're going to need to access your 401k account to supplement your income. Every now and then we come across people that have pensions and Social Security, and when they look at their pension and Social Security income, they say, that's enough to meet all my expenses, but I still have this balance that's going to be sitting in this 401k or 403b plan. In that case, if we don't think they're going to be withdrawing off of it in retirement, they're just going to let it continue to accumulate, it may make sense to do Roth because of the length of time that accumulation has to take place. And if they think, well, the kids are just going to inherit this, it's much more beneficial for the kids to inherit a Roth account than a pre-tax account, because beneficiaries for pre-tax have to pay tax on all of it, versus if they inherit a Roth account, they don't have to pay tax on any of it. It's not uncommon for people to run into these abnormal income years. And what I mean by that is, let's say we have a business owner who's normally used to making $300,000 a year and has been contributing pre-tax, but now the business has a rough year and he's only anticipating making $50,000. In that year, it might make sense for him or her to pivot and then go from pre-tax to Roth contributions because they're not getting that much of a tax benefit due to the lower income level. Vice versa, you might have some employees that work for a company's having a great year, they anticipate on getting a big bonus before the end of the year, so they're going to be in an abnormally high tax bracket for the year. If they were doing Roth before, they may decide, hey, I need to take income off the table this year, I should switch to pre-tax contributions. There are also some abnormalities that are common as you approach retirement. So the one is, when people retire, sometimes you get a big payout for back vacation, for sick pay, and you get a really big last paycheck to compensate you for all those things. In those years, you might want to make a final larger pre-tax contribution, knowing your income's going to be larger in that last year, but as soon as you're in the next year, you're retired and you're not going to have that income, and you could draw it out at a lower rate the following year. Another common situation is for married couples. They might retire at different times. So when they were both working, both had income, they might have been making pre-tax contributions due to their higher level of income. But let's say spouse A retires and spouse B is still working. Now they're in a lower bracket because they only have one paycheck. That might cause them to consider switching from pre-tax to Roth. As people begin to learn more about these Roth contributions, we usually get a number of frequently asked questions that I want to go through to offer you some clarification. So the first question is, do all retirement plans allow Roth contributions? And the answer to that is no. A Roth source is actually a voluntary source that an employer has to adopt in order to offer this to their employees. So we're seeing it become more common across lots of retirement plans, but by no means do all plans offer a Roth contribution source. The second common question we get is, can I contribute both pre-tax and Roth at the same time to a 401k plan? And in most cases, the answer is yes. What plans have is really an aggregate total dollar limit that you can contribute each year to a 401k, 403b, 457, and ERISA sets that limit. And for 2021, if you're under the age of 50, it's $19,500. If you're 50 or older, you get the catch-up contribution, so it's $26,000. So whether you want to do that all pre-tax, all Roth, or some combination of the two, you just can't exceed those limits. The third question we're frequently asked is, if you start making Roth contributions to your 401k plan, they ask, do I have to set up a separate account? And the answer is no. When you start making Roth contributions out of your paycheck to the 401k plan, it goes into your 401k account, but now they track it as a separate source, which they have to do, because if you're making pre-tax, now you're doing Roth and the employer's putting pre-tax money in, all this stuff accumulates, and by the time you retire, they have to be able to determine what amount is subject to taxes, The Roth amounts are not subject to tax, so normally when you get your plan participant statement, you'll see different line items of your total balance. It shows your pre-tax deferrals, your Roth deferrals, and any employer contributions as separate line items. The final question we normally get is when I go to retire and I've got both pre-tax and Roth money in my 401k account, what happens? So normally if you have all pre-tax, you just roll over the balance to your traditional IRA and take withdrawals from there. But when you have both sources, you have to set up both a rollover IRA and a Roth IRA. Your Roth money in the 401k goes to the Roth source. Your pre-tax money goes over to your rollover IRA, and that's how they continue to track it separately. A very special note about these Roth rollovers. Now, Roth 401k and Roth IRAs have that same stipulation that in order to get the earnings withdrawn tax-free, you have to be over the age of 59 and a half, and you had to have had that Roth account in existence for at least 5 years. Now, this is where people get caught. So there's that 5-year holding period within the 401k plan, but then when you roll the balance over to the Roth IRA, you don't get credit for the time that money spent in the Roth source within the 401k. You almost have to restart that 5-year clock. So even though you might be 62 and you roll the balance over to your Roth IRA, you may have to wait another 5 years before you can draw that money out all tax-free because you got to satisfy that new 5-year period. So a common solution for this is we'll have clients set up a Roth IRA 5 years before they retire, contribute $1 just to satisfy that 5-year clock. So when they go to roll over, that 5-year clock has already been satisfied. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.